Will the real estate market crash in 2022? What is happening with forbearance and foreclosures that may drive housing prices down? Plus, what should you do if you or someone you know are in the market to sell or purchase a home? These answers and more starting right now. Hello and welcome to Ask the Lender. This is your place for housing market updates, mortgage advice, and little known secrets to building wealth and paying less money in taxes. Are you aware that forbearance programs ended in January of this year? Did you also know that foreclosures are now at the highest rate since the start of the pandemic? Most people are focused on what is directly in front of them and do not know what is actually going on behind the scenes. You see, I started in the mortgage business way back in 2002 and experienced firsthand the housing bubble popping, the recession, and learned the hard way what to do and not to do. The previous housing market crash actually began in 2006, but most people didn't notice until later in 2008. So let's talk about forbearance for a second. Fewer homes in forbearance means more inventory will be hitting the market. Now that may be good news for some buyers, and it also may be bad news for people looking to sell their home in the next 3 to 6 months. Now that forbearance programs have ended, we are going to see more and more banks moving to foreclosure. So let's explain what forbearance actually is. Under forbearance, the loan servicer temporarily suspends payments on that mortgage, and they forgo their right to call that loan due and start the foreclosure proceeding. In 2020 and 2021, as a result of the pandemic, we saw an increase of owners on these programs and record low inventory of available homes for sale. No one wanted to move, people were out of work, families were locked in their homes, and it just really wasn't a good time to sell a home. And everything was really at a standstill. The few buyers that were out there were hard charging and bidding up the values of homes. Now here's a little of my story. Back in 2005, I was relatively new in the mortgage business, and during that period there were crazy mortgage programs that did not verify income or assets. These programs were called stated income and stated assets, or stated income and verified asset programs. Basically, if you fogged up a mirror, you got a mortgage. This flooded the market with new home buyers and inflated the values of homes. Being new to the industry, I was naive and I purchased my first home at the top of the market in 2005. Several months later, the housing bubble burst, home values plummeted, mine included, and everyone's home dropped in value. If you were around at that time, you remember what happened. The government flooded the economy with stimulus checks, and soon the market was flooded with inventory from people who had lost jobs, had their loans adjust to higher rates due to these ARMs, these adjustable rate mortgages, and they were forced into foreclosure. I think it was something like 1 out of every 4 homes in a neighborhood went to foreclosure. Because of the massive amount of inventory, property values fell dramatically. And in November of 2021, just last year, mortgages in forbearance fell to 1.67%. So to give you an idea of how big of a deal this was, according to the Mortgage Bankers Association, the peak in May of 2020 was at 8.5%. So that number dropped a lot. But check out these numbers that tell an even bigger story. Around 835,000 homeowners were in forbearance plans nationwide from June of 2020 to November of 2021. The share of homeowners exiting forbearance looks something like this. Now, hold on a second. This is important, so pay close attention to these numbers. 30% of those exiting forbearance exited with a loan payment deferral, meaning that the past due amount plus interest was added on to the back of that loan. 20% of those exiting forbearance were able to come current on their payments, and they were fine. Pay close attention here. 17% of those are still, to this date, not current on payments. 17% of 835,000 is 141,950. So somewhere over 141,000 homeowners are now facing foreclosure. 14% exited with a loan modification, which is also problematic because they can be at higher interest rates, a longer 40-year term, which means they're paying more money per month. Now, why is this noteworthy? Well, because a recession is coming. It's coming. More about that in another video. You may want to follow this channel. But during a recession, jobs are lost, businesses close, and these homeowners will not be able to make those higher payments. 12% of the loans were reinstatements, meaning they remain current on their payments. They came out of forbearance. No problem. 7% exited by selling the property or refinancing to cover the payment. The mortgage industry is going through some massive changes right now. And this info is a big deal because interest rates are climbing at a record pace. Inflation is out of control, and the Fed is threatening to raise rates maybe even 7 times this year. So if you take a look at the facts such as consumer sentiment, you will see that more and more people are becoming fearful of the economy. We have fewer jobs due to things like artificial intelligence, and businesses who closed their doors during the pandemic, they didn't reopen. So coming very soon, the housing market is going to see a lot more inventory as a result of the forbearance ending. I think they hit record numbers, and like 23,204 U.S. properties were in foreclosure, had foreclosure filings in January of this year. And this is the highest rate since the start of the COVID-19 pandemic. New home construction declined in 2019 and 2020, but it increased in 2021. So that means we are going to see more new homes hitting the market, which also adds more inventory. Now, for some folks like the DC metro area where I work, this may not be a problem, but in smaller markets, it will have a big impact. New homes hitting the market coupled with the increase in foreclosures will flood the market with new inventory and drive down property values. Full disclosure here, I am not a financial advisor, nor am I an economic expert. I'm just a regular dad who has experienced a downturn in the market, and I see the warning signs. So if you are in the market to buy or sell a home, you may want to act now while values are up and rates are down. If you find this information helpful, do me a big favor and hit that subscribe button, smash that bell to get notified when I share more helpful content just like this. See you next time on Ask the Lender.